Welcome back. Welcome back to our show. And My name is Anthony Citrolo with the NYBB Group. It's my pleasure today to have a good friend and fellow colleague, Mark Stone, with me. Mark is a CPA. Welcome, Mark. I'll get a chance to introduce you a little more formally. I just always like to tell folks who our guest is. Mark has a company called Sales Tax Defense, and he is really the foremost expert for folks who have, I hate to say tax problems, but or tax issues, or really want to understand the implication of sales tax on their business. For us here at the NYBB Group, we are here to really assist you. We look at to assist the people who are family-owned businesses, folks who are privately held companies, companies who may be seeking an exit at some point, perhaps want to know what the company's worth. Perhaps they want to explore the marketplace. They want to know what valuations look like out there. So we try to help them in that direction, as well as marketing the business. We jokingly titled the show "Firm Grasp on an Empty Bag," and we did that because a lot of times people miss a lot of very important factors in their business, and I think sales tax is one of them. And they could end up with less in the bag when they go to sell the company than what they expected. So, and some people have a lot less because there are things they really don't know about. So, in a joking way, we did that, but in a serious way, I think 80% of a lot of folks' wealth is trapped in their business. And if you really don't pay attention to it in every single respect, what you've worked hard and long for, and sometimes it's passed down from one family member to another. Maybe it's from one generation to another, or it skips a generation. Sometimes there's grandchildren working in the business. Our goal really is to make sure that you cash out and get really what you really deserve, because years of hard work sometimes are hard to be replicated, and we'd like to see maximum value created. So just a little bit about Mark. Mark, I think, started the company in '06, and he was a New York State tax auditor. So he's been there and done that basically. He's worked in major accounting firms. He's a CPA. Mark is one of the most well-respected guys in his area. He speaks in a lot of different places. He's spoken for the New York State Society of CPAs, the National Conference of CPA Practitioners. He's spoken for different bar associations, the Nassau and Suffolk Bar Association. I think he's one of the go-to people, especially here in the New York metro area. But I think he knows a lot about his area, that he could be kind of a national expert in terms of what he does. So, Mark, welcome to the show. I'm glad you can be here. I appreciate you taking the time out of your busy schedule to be here as well. And I know, if you want to just tell a little bit about yourself in terms of how you got started, perhaps. I mean, I just gave some brief bullet points, and I know Mark also just moved to a nice, brand new big office. So, business is good and expanding. So, just I'll give you a couple of seconds, couple of minutes to kind of just give a little bit more background in terms of what your passion is as well.
Sure. Well, as you said, I started after college as a New York State sales tax auditor, going out and asking businesses on Long Island for money. Like that's what the government does. Did that for a few years and decided for a number of reasons it wasn't the right calling for me. I went into public accounting. I worked at two of Long Island's larger accounting firms, doing their sales tax work for almost a decade. And exactly like you said, in 2006, I went out on my own. I started my own practice. I've since 2006 grown the practice to a total of 7 people. And all we do is sales tax consulting, very, very different than income tax consulting. A lot of people think of the IRS and income taxes and paying tax on when you make a profit. Sales tax is nothing like that whatsoever. Sales tax is just on gross receipts. So a lot of businesses run into trouble and they're like, well, I didn't make any money. I don't have to worry about anything. But no, if you have $10 million in sales and you have $10 million in expenses, you could still owe the government $900,000 in sales tax. So really can be a brutal tax if somebody doesn't know what they're doing.
I think it's come to the forefront even more so, I think, especially with, people have spoken about, Amazon and collecting sales tax in different states. And I think that's confusing to people. So maybe, if you could just clarify, what that means. We do have a lot of folks who have internet businesses, right? And they sell different products and services. And I think many of them just think that they're just not liable for sales tax unless it happens to be in their state. And I think it could be an area where there's some liability.
Yeah, well, what had happened in 1992, Quill, the office supply company, took the state of
Oh.
North Dakota to court and ultimately ended up before the Supreme Court. And the Supreme Court said in 1992 that unless you're physically in a state, you have an office in a state, your employees are going into a state, you're storing inventory in a state, you don't have to collect that state's sales tax. They called it a bright line physical presence test. So you could be doing $100 million of sales into a state. Doesn't matter if you don't have, an office in the state. You don't have to worry about that state sales tax.
So you had to have a brick and mortar presence, basically, right?
Something, or like I said, employees going into the state to make deliveries, make service calls, make something. And lo and behold, commerce changed, and in early 2000s, along came a little company called Amazon, and they were a little company. And they started selling books, but then they started selling electronics, and then they started selling everything. And what happened was, and New York State was one of the first states to go after Amazon, was they realized, well, as Amazon sells more books out of the West Coast, and they're not charging sales tax on those books, Barnes & Noble, B. Dalton, those other companies that are physically here in New York that were selling the same books are not selling those books anymore because people are buying them from Amazon, and New York State's not getting sales tax on it. So as the state started to lose more and more money to what they called remote sellers, they started to kind of come up with devious, ingenious, creative, whatever word you want to use, ways to tax these companies. Whether Amazon, they went after Amazon, saying that if Amazon paid referral fees or commissions to other websites in New York for referring links to them, that was the connection to New York. Massachusetts went after people saying that if the software company put a cookie on your computer, and not the cookie you eat, but a software cookie, obviously, that was a physical presence in the state. Different states came up with different methodologies to target these companies. It all came to a head in 2018. South Dakota went after Wayfair, Overstock, and Newegg and said, forget all the old rules, forget what the Supreme Court said. If you're doing more than $100,000 of business into our state, you have nexus and you have to collect sales tax. Period. End of story. So a lot of companies never thought about that. And a lot of my clients, I'm sure, Anthony, a lot of your clients, doing $100,000 of business into another state is really not that hard to break that threshold. No. So you have a New York-based company shipping all over the country, doing $5 million a year in sales. That's not a crazy large company anymore, $5 million in sales. They're probably exceeding $100,000 of sales, maybe into 10 different states, 12 different states. And the real problem there is if you don't collect sales tax, you still owe the sales tax. So, if you should be collecting New Jersey sales tax and you're not, New Jersey doesn't tell you the first day. They don't tell you the second day. They find out 5, 6, 7 years later. Lo and behold, 7 years later, they figure it out. They send you a bill for 7 years worth of back sales tax into New Jersey, which you never collected, 7 years worth of interest on that money, 7 years worth of penalties on that money. And sales tax, much like payroll taxes, is what they call a fiduciary responsibility. And what that means is that the owners and officers of the company are personally liable for that sales tax, even if it wasn't collected, and even if the company goes bankrupt. So it's really hard to get away from it. And I've seen, unfortunately, it ruin some people's financial lives. So, and it's a big thing that comes up that we should talk about when you're buying and selling a company.
It's pretty amazing because I think, I guess we always say knowledge is power. And it's amazing how many folks, I guess, really, not that they're looking to skip the law, but they really just don't know. Right. And so, and sometimes their advisors really are not, up on in terms of what really has happened. And, you'll see that happen. And we've been involved with folks who are collecting taxes out of fiduciary taxes. And it's just no one really realizes that they have some personal liability. But is it true, though, that, I have a lot of clients, Mark, who say to me, I don't make a taxable sale, so it really shouldn't affect my business. So I mean, they basically say, so why are we even talking about sales tax? And really, what's the problem with that?
Right. Well, so half the people that say that to me are they call themselves wholesalers. All I am is a wholesaler, so I don't, pay sales tax. I don't have to worry about it. So the joke that I tell, which is not a joke, whenever anyone says wholesaler to me, I say back to them snuffleupagus. And that for those of us that are old enough to remember, um, snuffleupagus was Big Bird's imaginary friend. Snuffleupagus doesn't exist. There is no such thing. There is no such thing as a wholesaler that's not responsible for collecting sales tax. What there is a retailer who's gotten resale certificates from all of his customers. And what I have seen time and time and time and time again, a client comes to me and says, I'm under audit and I'm a wholesaler, and now they want me to pay tax and everything. And I say, well, you need resale certificates. And I'll explain why in a second. So you need resale certificates. And they say, all right, I'm going to go back to my customers and get them. But now they're going back 3, 4, 5 years ago to try to get those certificates. The customers are out of business. The customers aren't themselves registered for sales tax, so they can't give a certificate. There was a billing dispute, so they're not talking to each other. And they end up getting half of the certificates for half of their sales.
Mm-hmm.
And lo and behold, again, $100,000 a year in sales, if you're paying tax even on $50,000 of that, $5,000 a year in tax,
Sure.
another $5,000 a year in interest and penalties. Who wants a $10,000 a year tax bill because you didn't get a stupid piece of paper?
That's a great, that's great. We have a lot of clients who are, manufacturers and distributors, right? They distribute the product they manufacture, and routinely they'll say, well, I am the manufacturer and the distributor. There's really no implication for me to collect sales tax. And I would say 9 out of 10 of them probably don't have resale certificates. So they're probably waiting, or they're probably never expecting anybody to kind of knock on their door. And I suppose especially New York State sales tax could do that at any moment, right? I mean, they could go by the board and not be found because they've never collected, or they never filed. But I assume that it's probably a big area where the sales tax folks can kind of reap some real real benefit there.
Yeah, and you run into a problem like in New York State, just as an example. Medical devices are not subject to sales tax when they're sold to a consumer, to a patient, but they are generally subject to sales tax when they're sold to a medical provider. So if you pull a muscle in your leg and you need a TENS unit because that's what they tell you to get, you don't pay sales tax on that. If the physical therapist buys a TENS unit for his office or her office, they do need to pay sales tax on that. So if you're the manufacturer or distributor of these TENS units and you say, well, it's medical equipment, there's no sales tax on medical equipment, that's not true. It depends who you sell it to. And again, the government is going to push that back on the business and say it's your responsibility to prove to the government that tax doesn't apply. It's not the government's responsibility to prove that tax does apply. You're guilty until proven innocent, and that's what a lot of people don't realize.
And I know that there are some businesses that, and I know I've been involved in some where not every product that you sell is taxable.
Yep.
So, you'll have, for instance, I was years ago, I was involved in some Carvel businesses, right?
Mm-hmm.
And in theory, anything for immediate consumption was taxable, and anything that was for take-home purposes wasn't. I mean, how does one really control that? And what do you see as problems there? Because it seems like, there has to be a good way for accounting for it. I mean, obviously now people, I guess, have POS systems.
Right. That's a big help.
And how viciously do they actually look at that? And how do folks, kind of look at their business and make sure that they're not, subject to liability?
Right. Or, Carvel is a great example, or Baskin Robbins, like I had last night because I'm working on my diet. The government's okay when you sell, because ice cream cakes are not subject to sales tax. Right. So that's easy for the government to see is not subject to sales tax. Prepackaged quarts or pints, that's easy. That comes in, that goes out a certain way. But when you get a 5-gallon drum of ice cream or whatever they get in Carvel and Baskin Robbins, and they're scooping that out, and they don't know whether you're scooping it into Sundays, which are considered for on-premises consumption and taxable, or whether they're doing hand-packed pints in quarts, which are not taxable. When the government audits that carvel, if the carvel doesn't have the right records, and they can't say that I sold 100 pints, they just look at the purchases and show that they bought 100 gallons of ice cream, the government's going to come down pretty hard on them and say, I don't know whether you sold pints or Sundays. We're going to tax it all, because if you don't know, we don't know. And people get crushed.
And, it's interesting you say that, because in our day, they routinely would look at our suppliers, right? And they would subpoena the information that the suppliers had in terms of what you were billed for. And they would actually say, well, listen, you bought X number of units that typically those packages are used for immediate consumption, and you're subject to tax on those. And we don't even have to, we'll just extrapolate the numbers.
Yep.
And they'd slap you with a tax bill. We've had folks who owned, restaurants and pizzerias and all that, who, basically have called us. We don't really handle a lot of those companies, but in the days that we did, they called us, and really some of them were sitting there with very large sales tax bills, and they wanted to sell the company. I'm looking at those kind of businesses. I mean, what happens in the restaurant in that environment? Because there's so much, cash going through the business, number one, right? There's payroll liability, I think. Just talk about how that all comes together. And probably it's all generated from sales tax issues, right?
Well, I think there's two big issues in the food industry. Sales tax is definitely one of them. I think my experience with the food industry, a lot of it actually stems from the labor. There's a lot of cash payroll in the restaurant industry.
Mm-hmm.
Some of that related to whether people are properly documented workers and whether they're not properly documented workers. But in order to pay people in cash for whatever reason, you have to underreport your sales, because where does the cash come from? Because you can't just make a journal entry on your tax return and say, cash payroll, $500,000. The IRS doesn't go for that. You do that, you're gonna have all sorts of payroll problems. So the states know that unfortunately, people are paying other individuals in cash and not reporting it. So food services is a big target, for audits. And what they do, they start with really your federal income tax return, and they know certain ratios exist. So they know the ratio of sales to rent, or sales to food. That's a good thing they look at. Sales to food is either 4 times or 5 times. So
yeah, they look at your cost of goods sold. They know, right? I mean,
Yep.
They should.
And a lot of places, because they're playing games with the sales, that number's not right. A lot of places, cash payroll, they show, I'm going to be serious, $50,000 or $100,000 a year in payroll for a restaurant. It's impossible to run any kind of place 7 days a week, 12 hours a day on $100,000 of payroll. So if they know the payroll is understated, that means people are getting paid in cash. If people are getting paid in cash, cash is coming from unreported sales. That leads to a sales tax audit. And if you don't have the right books and records, they can do all sorts of crazy things. Going back to carvel, you have no records, but they get your purchases. They realize that you bought 1,000 spoons. Well, if you bought 1,000 spoons, you sold 1,000 hot fudge sundaes at whatever it is, $8 a Sunday, whatever they get now for a hot fudge sundae.
Probably.
Into your sales based upon the number of spoons. And then you get into the whole fight with the government. Well, we give them 2 spoons instead of 1 because they're cheap plastic spoons and they crack and this, and the government doesn't want to hear it. Like, it's your job, unfortunately or fortunately, to keep records. And if you don't keep records, people get crucified. They really do. Yeah. It's sad.
Yeah, it's funny. I look at it. It's interesting. I had a conversation with a restaurateur, and we were talking about that. He goes, well, he said in a lot of restaurants today, the 90% of the revenue comes on credit card. So the cash element's being taken away, but I think that it still does exist. I think it's problematic. And what we find too, quite frankly, we always talk to folks about unreported sales. And unreported sales, people think, well, it's great because it's helping me along the way. And one thing I tell them is, when you go to sell the company, um, there's some benefit. You can actually, I say, build value by paying taxes.
Hmm.
And they look at me. That's not a real popular statement, quite frankly, but I'm sure, you see that too. And I mean, what's a recommendation, at least for somebody who wants to get to the point where they go to sell their business, and I mean, how does sales tax affect the deal too?
Right. Well, there's two pieces to that,
Sure.
and everybody knows about the housing market right now. And people that are trying to sell their houses want to get the most money for it. But in order to do that, you don't want water stains in the ceiling and leaky pipes and a window that's rattling. When people are buying a business, they don't want to buy all sorts of problems either. And when you've been playing games, that's what you're running into, is that, you have all these problems that are just waiting to be discovered. Um, whether it's a sales tax audit, whether it's a payroll tax audit, whether it's a Department of Labor wage and hour audit, you have all these things floating around waiting to happen. Specifically, when you sell a business in New York State, there's something called a bulk sale notification.
Hmm.
What a bulk sale notification is anytime one business sells its assets outside the ordinary course of business. So if a restaurant is selling its tables, its lease, its recipes, its phone number, those are all irregular sales. That's all outside the ordinary course of business and
Sure.
requires a bulk sale notification. And what New York State says is the person buying the assets buys all of the sales tax liabilities from the old owner, from the seller, up to whatever's paid for those assets, unless they get a tax clearance letter from New York State. So then you have to write into New York State to get this tax clearance letter. And then what happens? New York State comes and usually does an audit on the selling business to see if they owe any back sales tax. So then if they've been cheating all along, that's where they get caught. So, I mean, of course, the recommendation is not to cheat on your taxes. That's a very easy thing to say. But certainly something that goes along with that. If you're selling your business in the next 3 or 4 years, it's honestly time to find, as I would say, religion, and do it the right way for the last 4 years of your life. Listen, you beat the government for 16 out of the last 20 years, say thank you. Time
That's
to
right.
do it right.
Now, the bulk sales tax clearance is something that one needs to file for ahead of time, right? So
Yes.
if we're selling a business, and somebody's selling their company and they want to close on the business, let's say, the end of the month or the end of next month, is there a time frame that they need to do that with? Is that something that's done after the sale or before the sale?
Well, what New York State says is you have to hold all of the sales proceeds, 100% of the sales proceeds, in escrow until they give you the tax clearance letter, and they have 90 days to give it to you. So while typically a lot of people want to file 10 or 20 days before closing, my actual advice is to file it 90 days before closing and see, what the government comes back with. This way, at the closing table, you have the tax clearance letter, and you can really just kind of walk away, shake hands, do the deal, and be done.
Sure.
A lot of deals that I've seen get blown up when somebody says, well, you got to hold all the sales proceeds in escrow, and the seller is like, you're not holding my money for the next 3 months, and it blows it up. So
We've seen that happen. Now, my question to you is, so if someone's purchasing the assets of another person's company, you said the sales tax liability transfers over. Is that even if I'm not buying that corporate entity?
yes, even if you're not buying the corporate entity, and not necessarily on taxable assets. So let's pretend my accounting firm is buying Anthony's brokerage business, and we reach a deal. I'm going to buy his brokerage business for $1 million, and it's an asset deal. And what I'm buying is his website for $100,000 and his telephone number for $100,000, and his copyrighted materials for another $795,000. And for $5,000, I'm buying that nice leather chair that you're sitting in. So now the government's looking for two things. So that $5,000 leather chair you're sitting in, I owe the government $500 of sales tax because I'm buying a chair. That's easy. But what they're also going to say is, oh, well, wait a minute, Anthony, all along the way, you were buying information services to help you price the businesses that you were advising along the way. And you bought those information services from an out-of-state company that never charged you sales tax. So, lo and behold, you owe the government $250,000 of back use tax on all of these information services that you bought, but you never paid tax on. So
Yeah.
now I buy your business. Not only do I owe the government the $500 of sales tax on your nice leather chair, but since I bought your assets, your copyright, your phone number, your website, I owe the government the $250,000 in back sales tax that you didn't pay on information services from
Wow.
3 years ago. That's how they get you. That's the real danger in a bulk sale, not the tax on your leather chair. That doesn't really make any difference. It's that hidden liability that nobody thinks about that they get caught up on.
And that's irrespective of what's in the terms and conditions of your agreement, huh?
Well, the
With
agreement is between two businesses in New
between
York
two
State.
businesses, yeah.
That agreement doesn't change the tax law in New York State. You don't get to make a contract that changes what the government does. The government gets to come after whoever they want for the taxes.
Amazing, amazing. So, it's the things that people really don't know. I mean, I've seen actually a transfer of a business where the owner came in one day, the new owner came in and the business was padlocked.
Right. Just
And then he
boom.
goes, well, what do you mean it's padlocked? He really had no clue in terms of what's going on. And he had a real problem in terms of, he had already transferred the money to buy the business.
Mhm.
And here he is. He has a padlock business. It's just, it was incredible. It was, the outcome was pretty ugly from a legal standpoint.
Mhm.
It cost a lot of money and a lot of time to get it resolved. So it was an issue. So what I'd like to do is, I know you've handled some interesting cases without, being specific or, keeping confidentiality. Just give us a little flavor in terms of, what's kind of hot today, what you're working on that you see as a real issue, or what's kind of even new in terms of things that you say, gee, you know what, this is something that really has to be needs some protection. So the audience has a good idea of like a good way to protect themselves and what they can look for.
So the first thing I want to say towards that is that every business, which means every business, which is every single solitary business, should be filing a sales and use tax return. Even if you're reporting zero quarterly, zero annually, it starts a statute of limitations running. So the government can only come back to you for the last 3 years. If you don't do that, they get to come back to you for 6 years, 7 years, some states 10 years, and bill you for back sales tax for 10 years. If you file an annual zero sales tax return in New York State, they can only come back 3 years to you. So that's the first thing that everybody really should know. The second thing is businesses that you wouldn't think get audited, but probably one of my biggest groups of clients is contractors in the construction industry. A lot of people say, oh, well, new construction, there's no sales tax, new kitchens, new bathrooms, but all those contractors need to pay tax on all the materials they buy. And a lot of them don't know that. And they go out and they buy materials from out of state, cabinets that get shipped in from North Carolina, lumber that gets shipped in from Canada, steel that gets shipped in from Pennsylvania, windows that get shipped in from all over the place, marble that gets shipped in from Europe. They don't pay any tax on it. New York State comes in and says, yeah, listen, we're not even going to look at your sales. You do $3 million a year in home construction. Great, no problem. And that's the end of the discussion. But you spent $1 million in materials. Prove to me by showing me the actual receipts that you paid tax on $1 million in materials. You don't have the receipts, or the receipts don't show tax. You now owe us $85,000 a year in tax. Again, say 3 years. That's a $250,000 bill plus interest and penalties. Can easily be a $500,000 bill. And $500,000 to a company that's doing $9 million over 3 years. That's still significant dollars.
It's big money. It's funny, I would almost think that it's the responsibility of the vendor to collect the sales tax, but I guess their attitude is, if you haven't paid it, ultimately, we're going to get it from someone.
Right. And why would that Canadian company selling lumber into New York care about collecting New York sales taxes? There's very little that New York can do to a Canadian company or an Italian marble distributor. They maybe can do a little bit more to a New Jersey window vendor, but not
That's
much.
helpful. We do a lot of work with contractors, so I'm curious to see, what kind of protection they have in terms of. They probably haven't even thought of it, quite frankly.
Yeah, that's a big thing. And then the other big thing is we were talking about Nexus, this Wayfair decision in 2018 that overturned the Quill decision. That now these companies have Nexus in many states, and I'm seeing all of these audits popping up. My New York, New Jersey, Connecticut customers. They're getting notices from Nebraska and Wyoming and Texas and California and Florida. And you never thought about it. And that's been a very big thing. A lot of people, now a very common business practice is to use Amazon for fulfillment services.
Sure.
Very common. Well, the way that model works is if they're selling your widgets, you need to send them 500 widgets, and they put 10 widgets in every state. So that way that you can have next day shipping with Amazon Prime. That's their business model. But that's still your inventory. You still own those 500 widgets. So now you're storing inventory in all 50 states. You have property in all 50 states.
Wow.
So
Wow.
now you have Nexus in most of those states. I won't say all of those states, but most of those states. So that's a big thing people are getting caught up on. And California got smart to that. And they sent the subpoena out to Amazon for what companies were storing inventory in the California Amazon warehouses. And Amazon fought it for a year or two in California courts and lost for a year or two in California courts and turned over 700,000 business names to the California Board of Equalization.
Wow. Wow.
And the California Board of Equalization sent out 700,000 notices.
Easy pickings, huh?
Right. All computerized. They get an electronic list, they do a mail merge, and they send it out.
Yeah, it's funny. You think about a small business owner who's depending on Amazon, then all of a sudden they have this liability in states. I mean, they're so thrilled that they're actually selling product in different states.
Yeah.
And they probably never think about the liability associated with it. And then, the filing requirements become pretty intense.
Yeah.
In terms of actually getting that accomplished, right? So I think
it's a pain,
that's a problem. So, wow, that's great. Well, look, we're pretty much at the end of our half hour, believe it or not. It's even a little bit over, but I wanted to give you the platform at the end to kind of give what would be final thoughts, and also let us know how the audience can contact you, because if they have some questions, I'm sure you'd be willing to answer those questions about sales tax, and also there may be some people out there who never realize that they have a problem, but they want to offset it or want to avoid it. So just give us some final thoughts in terms of what folks should be thinking about who are in business, and also a way to get in touch with you.
So getting in touch with me is easy. The name of my firm is Sales Tax Defense. We're here in Deer Park. The website is www.salestaxdefense.com. My email address is mstone, M-S-T-O-N-E, at salestaxdefense.com. And my phone number is 631-491-1500. I'm at extension 11. So that's the easy part, how to reach me. The advice that I would give everybody is, and it's a very common overused saying, but it's true, you don't know what you don't know. So we do consultations with people all the time. Just so you know in advance, we charge $450 for a consultation, so nobody's surprised. And we go with them what they should be doing. I may not be able to fix everything in an hour, because that's what a consultation is. But now you're at least aware, oh, wait a minute, I'm shipping into 6 different states. I should be charging sales tax in those 6 different states. And this way, the business owner can make the decision. I want to set up the administrative infrastructure to do it the right way, or I'm going to roll the dice. The biggest thing that I found that business owners despise is when people take the choice away from them. When they're given the choice, I'll take the risk or I won't take the risk. Sure. They're okay with that. But when their accountants or their advisors just don't give them the advice so they can't make a decision, they're furious all the time. Why didn't they tell me? I see people screaming at their accountants all the time. Yeah. Why didn't they tell me?
So yeah, that's a great point. And obviously it's because they probably didn't know, right? So to a great degree, they just didn't know. They don't know what they don't know. And I think look, my point too is, and I'm glad you were here, Mark. Areas like yours have gotten so complex. I mean, maybe they were always complex. It seems like they got more complex, and it really takes the audience should look at somebody like yourself as an expert. You really need to have experts. I mean, we talk to folks about transactions all the time. How you need a contract oriented attorney to do your transaction. You need a great tax person to understand the tax implications, the income tax implications of the transaction. And I think, when we bring experts in, we need somebody who's really knows the sales tax part of it, and don't think, for the audience's purpose, it doesn't apply to you, because it does apply to you, and it applies to everyone who's in business. And filing your sales tax return quarterly is something I'm going to bring to people and make sure that they realize it's part of their obligation. So I appreciate you being here. I mean, look, here at the NYBB Group, I try to bring really the best of the best people who I'm fortunate to know people like Mark in terms of people who understand and are experts at what they do. And I think, I would hope that anyone who has any questions reaches out. I can put you in touch with Mark in case you didn't get his information. And our goal here at NYBB and on the show is to just inform you and just help folks who really to protect that investment. If 80% of your worth is really your wealth is really tied up in your business, then it makes even more sense because it could be your key to retirement. And all of a sudden you have a sales tax problem and somebody says, hey, by the way, you owe $500,000. It comes out of your proceeds. It could have a major impact on you. So Mark, thanks for being here. You have a great day. And to the audience, we'll see you next time. Thank you.
Thank you.